So welcome to this presentation on cost of capital, continuing with the series on ratio analysis. Now, what is cost of capital? From a company's perspective, cost of capital is cost of company's funds, and from an investor's point of view, it is required the rate of return by investing in the company's security. The following areas would be covered in the presentation. What is the weighted average cost of capital? Cost of various components of capital multiplied by weightage. Cost of equity, various methods of calculating cost of equity. Evaluating each method of calculating cost of equity, benefits and drawbacks of each method. Beta of capital asset pricing model. The statistical concept of beta, volatility and correlation. Factors affecting equity risk premium, concept and explanation, mathematical calculation uses. Optimizing cost of equity, the right time to issue equity and buy back equity shares. I am Aninda Datta, the presenter. Now the weighted average cost of capital is calculated by averaging the rate of all the company's sources of capital weighted by the proportion of each component. Now suppose the components of the weightage of each component of capital in a company are given by this pie diagram, whereby the equity comprises 50%, the debt comprises 40%, and the preference capital comprises 10%. K is the cost of equity, KD is the cost of debt, and KP is the cost of preference capital. As interest on debt is tax deductible, so income tax saved on interest payment is deductible from the cost of debt. So weighted average cost of capital is given by the formula, that is the weight of equity into cost of equity plus weight of debt into cost of debt plus into 1 minus tax rate plus weight of preference capital into cost of preference capital. So this is the formula which gives the weighted average cost of capital. Among the various sources of capital, the determinants of cost of equity capital are not explicit. So cost of equity is implied from other market indicators. So there are many different concepts and methods of calculating cost of equity. Now let's see what is the cost of equity. Cost of equity is the return expected by the investors from equity. That is, the investors see it as an opportunity cost of investing in a substitute asset having similar risk and return profile. Now, what are the main methods of calculating equity risk premium? So the methods of calculating cost of equity, the different methods of cost of equity. The most widely used method is the capital asset pricing model. Here the cost of equity equal to risk-free return plus beta, that is RM minus RF. This method compares the risk of individual shares with the market risk to scale up down the expected return from the share. Here RM is the return expected from market and RF is the risk-free return. Multiplier method, like price to earnings, price to sales. Here the cost of equity is calculated from the earnings, sales growth to growth in earnings, sales needed to maintain the present market price. Dividend capitalization method. Here the cost of equity is given by the formula dividend per share divided by current market price plus dividend growth rate. Discounted cash flow method. All future cash inflows to shareholders are discounted to the present market capitalization. The discount rate is the cost of equity. As the risk to equity shareholders is the highest among all the investor categories, so cost of equity is highest among all the capital sources. In a running company, the equity shareholders have stake on future cash flows only after interest on debt and dividend on preference shares have been paid. During liquidation, equity shareholders have stake in the company's assets only after all the stakeholders have been paid off. The drawbacks of cost of equity calculation based on discounting future cash inflows and the future dividends. The price of all assets depends on the present value of all future cash inflows from the asset, but predicting the future is extremely difficult. The main drawbacks of the discounting method are it is extremely difficult to predict future cash inflows and the future dividends over a long period in the future. The present value of discounted future cash inflows. All future expected cash inflows in equity shareholders are discounted at an appropriate rate to arrive at the present market capitalization of the company. The discount rate used to make the future cash inflows equal to the present market capitalization is the cost of equity. The drawback is it is extremely difficult to estimate the future cash inflows to shareholders accurately. The dividend discounting method. Cost of equity equal to dividend per share divided by market price per share plus the growth rate in dividend. The growth rate in dividend is assumed to be constant in the formula. Anticipating the constant dividend rate is extremely difficult. Dividend payouts vary between companies, and some profitable companies with high growth potential declare low or no dividends. So dividends from equally profitable companies vary. So it is not very prudent to value company based on dividends only. Now let's study the capital asset pricing model. This calculates expected return from an asset by using risk-free return, expected market return, and correlation of the asset to the market. Risk from the asset equal to risk-free return plus beta into RM minus RRF. Whereas our asset is the expected return of the asset, RRF is the risk-free return taken as a return of a long-term government bond in the country. RM is the equity market return, beta is the risk of the security compared to the market risk. RM minus RF is the equity risk premium. The market volatility of the asset price is considered the risk and is measured by the standard deviation of the return. The study of statistical relationship between the two variables is called the bivariate analysis. The returns of both a specific asset and market are deemed to be following a normal distribution. So the statistical relationship between the asset return and the market return is given by the bivariate normal distribution. The slope of a regression line between the two normally distributed variables is given by the following formula. Slope equal to correlation into standard deviation of y divided by standard deviation of x. The value of beta of an asset is statistically equal to covariance between asset and market divided by the market variance. Correlation between two random variables equal to covariance yx divided by standard deviation of x multiplied by standard deviation of y. Now replacing the correlation in the equation of slope, we get the following formula. Thus cancelling out standard deviation y from both the numerator and denominator, we get the following. Slope equal to covariance y and x divided by variance of x, as square of the standard deviation is the variance. Thus return of an asset, that is the expected return of an asset, equal to the risk-free rate of return plus covariance between asset and the market returns divided by the variance of the market multiplied by the expected market return minus the risk-free rate. This is the most widely used method of calculating cost of equity. Though there are many other measures of risk, volatility of the asset price is considered as the measure of risk in capital asset pricing model method. Some empirical evidences show that asset classes with higher volatility give better returns most of the time. Now, higher the volatility of asset, higher is the return expectation as per CAPM. The graph depicts the capital asset pricing method. If the beta of the asset is 0, that is the volatility is 0, then the expected return from the asset is the risk-free return. If the beta of the asset is 1, that is the volatility of the asset is equal to the market volatility, the expected return is equal to the market return. If beta is more than 1, the expected return is more than the market return. Now, what is the multiplier method of cost of equity calculation? A popular multiplier used to evaluate the share price is the price earning multiplier. That is the share price divided by the earning per share. The reverse of that gives the yield of equity. That is earning per share divided by the share price. The average of this earnings yield over a period of time is also termed as the market expected cost of equity. The excess of earning yield over risk-free interest rate is called the equity risk premium. That is the extra return earned by investing in equity. Thus, the equity risk premium in a market varies with time and is influenced by many factors. Now, the equity risk premium is dynamic and influenced by economic growth, inflation, interest rate, global events, and the regulatory environment. The graph depicts the earning yield of Standard & Poor from the year 2008 to 2023. Higher the economic growth, higher is the price earning multiplier, lower is the earning yield, and lower is the equity cost. The higher risk-free interest rate increases the yield expectations from the equity, so the cost of equity always goes up. The risk premium also goes up most of the time. If the global and local risk levels go up, the market volatility goes up, the equity risk premium also goes up generally. Central bank policy like quantitative easing, increasing price earning multiple level and reduces the equity risk premium. The ERP goes up during the quantitative tightening. Now this graph, the blue line indicates the Standard & Poor earning yield. This is the 10 years earning yield, that is the risk-free return. The green line is the green curve is the equity risk premium, and the median ERP is given by this. The median equity risk premium is given by this line, straight line, which is the 3%. The cost of equity is the sum of risk-free return plus the equity risk premium. For the period 2008 to 23, the ERP varies widely from 1 to 6%. So the cost of equity also varies widely. The Standard & Poor yield, the cost of equity varies from 3% to 9%. Just from 9% to 3%. The cost of equity could be optimized by selling equity when P multiple is high and buying back when the P multiple is low. If risk-free rate is constant, higher the equity risk premium, higher the yield from equity. The lower the price to earning multiple, so higher is the cost to equity. When the price to earning multiple is high, mainly during the bull markets, equity risk premium and the cost of equity are low, so it is advisable for companies to raise equity. When the market interest rate is high, the earning yield is high, that is P multiples are low, the companies generally do not raise equity during those times. During times of high earnings yield and low P multiples, many companies buy back the shares if their expected future return on capital is more than the cost of equity. The future episodes will cover cost of debt and optimizing the overall cost of capital. So this concludes this presentation. Thanks for watching.